Hi there. How do you go about deciding whether to invest in new or growth companies versus buying shares of mature company? Of course, investors out there have varying preferences. Some might buy shares of a new or growth company because they assume it's going to grow much faster. Others might buy shares of a mature company because they assume that company is safer. You are all much welcomed as we dissect these nuances. My name is Afagza Sifuna. In case you are new, consider subscribing to this channel and also drop a like on this video. Let's jump at dissecting terms. What is a new company? A new company doesn't necessarily mean a company which started yesterday. It could be a company which is recently listed at a stock exchange. Characteristics of a new company are rapid expansion, reinvesting of profits, lower dividend payouts, because remember, they are aggressively reinvesting profits, higher risk, and then higher potential for return because they are probably also growing. Imagine a young entrepreneur opens a restaurant across Nairobi and they are on the verge of expansion. Instead of paying themselves, they are probably plowing back their profit into the restaurant. That's exactly what growth companies do. Instead of paying shareholders today, they invest heavily for tomorrow. Then, what is a mature company? A mature company is typically a business that is already established. Mature companies have established themselves and they've captured a large market value or market share. Their growth allows slowdown because they are already big. Instead of expanding aggressively, they generate stable profits. Many return those profits back to shareholders as a percentage of the profit through dividends, whether it is interim dividend, final dividend, or the first and only declared final dividend. And companies in Kenya are known to return part of the profit to shareholders, companies like Safaricom, KCB, EABL, NCBA, you name it. All these companies are mature companies and have shared their profits with shareholders. Having understood that, how do investors actually make money? Please remember, when an investor pumps money or invests in a stock market, there's only two ways they can make money: through either share appreciation or dividend. Share appreciation is basically where if they buy at a lower price and then the share increases, if they decide to sell, they're gonna sell at a higher price, okay? And for the share appreciation scenario, no dividend is needed. They have made their money through share appreciation. The second way is through dividends, where a company pays you part of its profit through declared dividends each and every year. If, for example, you own 10,000 shares in a given company, okay, and they pay you a dividend of 1.5 Kenya shillings per share, you're going to get dividends of 15,000 shillings come the end of the particular period. That is great for investors because they get dividends. So, why do new companies create huge wealth? Let's start on the exciting side first, okay? The growth phase. Growth is very big for new companies. Imagine investing in a company before everyone else realizes its potential. As profits increase, investors become more and more excited. And that is what drives price higher because the market forces on demand and supply. As demand increases, the share price rises dramatically because they're going to be more and more exponential growth on the demand side, thus pushing prices up. And of course, companies out there do reward early entrants through share appreciation. But here's the important point. Not every new company succeeds. That is what most people forget. In fact, many of the new companies do fail, and even some never become profitable. They disappear completely. That's why investing in young companies involves much more uncertainty. Think of it like planting mango trees. Some become huge productive trees, some dry up before even producing a single fruit. And to give you an example, in Kenya, imagine a newly listed technology company at the Nairobi Securities Exchange, okay? It gets to the bows, fair enough. Profits are small today. They're not paying dividends, okay? Investors believe earnings could grow 5 times even in the next year or two, you name it. Very optimistic. And that, if it happens, share prices could increase significantly, okay? The business will be doing very well. But its growth disappoints in real scenario. Prices will automatically fall sharply. And that is a risk to investors because they lose their capital and there's no potential for dividends. Now, how do mature companies create wealth? And that is important. Now let's look at established business. Suppose you buy shares of a company like Safaricom, EABL, NCBA, you name it. Will the company suddenly become 10 times bigger? The answer is probably not, because it's already a mature company. This is what happens instead. Year after year, millions of customers continue buying airtime in a company like Safaricom, okay? Year after year, millions of customers continue using M-Pesa. Customers daily continue buying data bundles. They continue using enterprise business solutions from Safaricom. The company does generate enormous cash flows, okay? Instead of keeping all that money, given they are making profit, they could decide to share part of that particular money with shareholders through paying part of the profit as dividends. Guys, that is a good scenario because, yes, you won't double your share overnight or every month, but be sure you're going to get a dividend, which is going to be very significant for you. More so at the point is declared. You can use that particular dividend to either decide to reinvest or even pursue other opportunities with it. And in the Kenyan market, historically, companies like, for example, Safaricom, KCB Group, EABL, Standard Bank, NCBA have declared and paid dividends. In fact, last year, I was looking at the percentages for companies like, for example, Standard and BAT. Their dividends were upwards of 14%. Of course, dividends are discretionary by the company, but then again, historically, if a mature company has paid dividends, chances are they're going to pay in the future. So, which of these options make more money? You investing in a growth company versus a mature company. Which one actually does make more money? The answer is that it depends. And I'm saying it depends because we need to look at this critically. So, let's compare. The first scenario, you invest 100,000 Kenyan shillings in a given company. Okay? Growth company is growing at 20% annual growth. No dividends. After many years, your investment could become several times larger if the company continues to execute very well and remain on that particular growth trajectory. Scenario 2, you buy shares from a mature company that pays dividends, okay? Prices only grow modestly, even we can say negligible growth, okay? But every year, you receive dividends if you reinvest those dividends or buy more shares in that particular company. Your wealth essentially compounds. You don't need to cash out your dividends, you can reinvest. Many investors understand how powerful the concept of compounding and reinvestment is. That's why seasoned investors capitalize on this. Growth companies often generate higher returns if they succeed. Fair enough. But mature companies often generate steadier, much more predictable returns. And with all this, let's look at the biggest risk in a very honest way. Both of these strategies have risks, okay? New companies can fall big time, right? New companies have very high volatility in whichever direction, whether it is growth or even declining. And unfortunately, new companies may never become profitable, or if they pay dividends, little to no dividends, right? Investors' expectations may be too high, okay? And then mature companies on the other end, their growth is much slower. But then again, they are steady in their growth. Share prices might stagnate, okay? Industry disruptions might hit them, okay? Lower long-term upside on this growth or mature companies, okay? No investment is risk-free. You need to understand that. The goal isn't you putting your money in a perfect company. The goal is you having good of both worlds. So, how should you buy? I think if you are young and you have a long investment horizon, can tolerate volatility, then growth companies may deserve a place in your portfolio. Not having said 100%, okay? And if you are now approaching retirement, you need a regular income or prefer stability. Dividend-paying mature companies may be suitable for you. Personally, I don't think investors need to choose one or the other. The stronger portfolios often combine both because you need to enjoy both of both worlds, okay? And even within the spectrum of growth companies and even the spectrum of mature companies individually, you need to build your portfolio. You could decide, for example, to invest in a ratio of 40 to 60, 60 to 40. You decide. You can allocate whichever percentage to whichever type of companies and then build your portfolio. The most essential thing is you being very cognizant of what you're doing and also diversify even within the level of maturity and the sectors which these companies are being drawn from. Because you want to diversify so as to build a diversified portfolio, which is going to ensure you are able to make money because at the end of the day, you have minimized your risk while also you are chasing share appreciation and having your eye to receiving dividends, which you can plow back to enjoy the benefit of compounding of your investment. Guys, if you have analyzed your investment from that lens, which of these investments have you jumped onto? Which one did work for you? Okay? Comment down below in the comment section. Let us continue discussing there. Cheers, guys, and I look forward to share with you other amazing videos next time. Take care. Speak in the next video.